Battery electric vehicle stocks are trading at sky-high valuations right now, and I've decided to throw my hat in the ring here and share some of my thoughts on whether this entire industry is in a giant bubble or not. If we only look at Tesla's current $1.1 trillion market cap, then it's difficult to make sense out of any of this, since there is no way you can use any kind of traditional financial metric to justify this price point. Basically, if you want to invest in this sector, or if you want to hold your current investment, then you need to be a believer. You need to believe that electric vehicles are an integral part of the new era of disruption, an era where multiple technologies are converging to challenge legacy industry that have gotten bloated or too set in their ways. To start with, EVs are challenging the automotive industry status quo. It is not just that they are in greater demand than ICE vehicles, it is that they have rendered ICE vehicles undesirable. And it is not just consumers that are adopting this mindset. Entire governments have jumped in on this action and have set dates for the end of the internal combustion engine. And then there is the inevitable demise of the oil industry. EVs are removing our dependency on a primary energy source, gasoline, and are replacing it with a secondary one, electricity. This is an energy source, by the way, that you literally have an ability to generate yourself. You now have a car company like Tesla that is not only selling you the car, but the fuel that goes inside it, thereby displacing probably the largest industry on Earth. And the EV movement is even more than that, because EVs bring with them a level of innovation not seen before. Tesla has figured out how to turn a $50,000 vehicle into a platform for future services, and they have software to sell that costs over $10,000 to buy. The list of industries that are going to be disrupted by a single company goes on. We know that taxi industries are staring at a potential tsunami, as is the auto insurance market, thanks to autonomous vehicles. Now, these are the beliefs that are driving valuations today. But many of us who witnessed the dotcom bubble firsthand have seen all of this before. This is exactly what it was like in 1999, when mobile broadband data was becoming a thing, and the internet was just alive with possibility and our imaginations were running wild. There was tremendous hype around anything with a .com in its name. One of the most spectacular failures was a company called dotcom, which was an online sports clothing retailer that launched in 1999, burned $135 million in venture cap funds, and collapsed less than a year later. If you looked at their website back then, you would have seen a lot of aspects that would be pretty normal today. Avatars guiding you through a purchase process and imagery to help you view and decide what you wanted to buy. You see, dotcom was not wrong in their thinking, only in their execution. It was massively ahead of its time. It was trying to do graphics-heavy web pages in a time when dial-up speeds averaged 56K. Just imagine that. In a world where you now have 2 gigabit per second download speeds, could you even imagine trying to browse through Amazon on a 56K modem? One reviewer described the experience as 81 minutes to pay too much money for a pair of shoes that are still going to have to wait a week to get it. Look, there were a number of well-documented reasons for the spectacular demise of dotcom, including that the entire online retail supply chain and delivery process was still in its infancy. But I wanted to point out that their biggest flaw was that they were way too ahead of their time. There were lots of other disasters of that era, even ones with famous backers. Pets.com had the backing of Amazon, who had a 50% shareholding, and who at the time was clocking $1.6 billion in revenue. But even this backing was not enough to save them, and Pets.com liquidated in November 2000, with only 2 years in operation. Fundamentally, they were not able to offer a better service than what could be obtained simply by walking into your local pet store. Online delivery was still very much in its infancy back then. Once again, Pets.com was way too ahead of its time. I mean, Amazon ended up building its entire business on this exact same model. But the most spectacular failure of all, the poster child of a true bubble, was Qualcomm. In 1999, Qualcomm's share price climbed 2,621% in a year. That is a 26x return. In a year. By December 30th, 1999, Qualcomm posted earnings of 34 cents a share and was netting $200 million in retained earnings and trading at a $100 billion market cap. Its pre-split share price was $650 and was trading at roughly 25 times sales, which in today's climate is not that bad. Qualcomm wasn't the only one with a 10x return that year. The New York Times reported that 12 other stocks had 10x that year, and a further 7 others had done 900% increases. This was in an era where, in the previous 9 years, only a single stock had ever managed to do 900% or more in a year: Amazon in 1998. Even IPOs got completely out of hand. Here we have Goldman Sachs trying to price an IPO for a company called Free Markets. They readjusted their initial target price 3 times before listing on $48 a share, and on opening, the stock closed out 600% higher on day 1 at $290 a share. So was everyone there wrong in their valuations? Well, the hype around Qualcomm was possibly justified. Analysts such as Walter Pacek from Payne Weber, in this article here that I was able to find, honestly believed that Qualcomm would dominate the global mobile phone market with license royalties from an 85% market share of all handsets on Earth. More than 400 million handsets were sold globally in 2000, and Qualcomm's license was tipped at 5% of the sales price of the device. Qualcomm was looking at anything north of $2 billion in straight-to-profit license revenue, with a growth rate equal to that of the entire global mobile phone rate. And this 85% market share was a justifiable belief. It was not outlandish. Qualcomm really did have watertight patents on CDMA technology, which had already seen widespread adoption in the USA. Everyone assumed that this would be accepted as the global standard. Unfortunately for Walter and many others, they were wrong. The ITU posted a specification for 3G that was less reliant on Qualcomm's patent, and their market share was estimated to only be around 19%. In 2000, Qualcomm started to miss their consensus earnings, and the price started to decline precipitously. But Qualcomm was still an excellent company. Only it took 20 years for Walter and all who shared his conviction to break even. I suppose there are 2 other companies that are worth mentioning for understanding the relevance of the dot-com bubble to today's market dynamics, and that is Microsoft and Amazon. In 1999, Amazon was booming. It had already 10x'd, with a 900% increase in 1998. Amazon did $1.6 billion in revenue in 1999 and had a market cap of $26 billion, so it was trading around 16 times sales, having peaked at around 20 times sales when it double-topped at $100 a share. Microsoft, at the start of the decade, was a blue-chip stock with a $615 billion market cap and was clocking $22 billion in sales. It had an outrageous PE ratio at one point, 75 times earnings and a price to sales of around 27 times. Amazon and Qualcomm fell 90% the following year. Microsoft fell 60% and remained range-bound for the next 12 years. An Amazon investor at the peak was able to break even in 9 years. But here is the thing. In 1999, Amazon was not yet profitable. It only broke even in 2003. And by then, the investment community had grown wary of dot-com stocks. For the better part of 7 years, you were able to pick up Amazon stock at a bargain price of less than 2 times annual sales. Can you imagine this? I mean, look at this company's growth. It has never had a decline in sales. In 2006, when Amazon Web Services launched, you were basically getting that business for free. Microsoft is a different story. It fell 60%, but Microsoft's business was also starting to reach maturity. Its numbers were never really that fantastic, and its sales growth was pretty flat for a considerable period of time. It was really only when cloud services took off in 2010 that Microsoft started to truly reinvent itself. So the point I'm trying to make is this. Tesla is fundamentally overpriced right now, and there is an awful lot of leverage behind its current valuation. It is Qualcomm-esque and Microsoft-esque in its valuations. But Qualcomm was hit with a binary event, an existential threat that changed the investment thesis. It lost the ability to get the 85% handset market share. Microsoft started to underperform as a business, and the stock price followed suit. So does Tesla have a binary event in its future? Or is Tesla going to underperform for a decade like Microsoft? Tesla is actually quite profitable, unlike Amazon at the time. Also, Tesla is disrupting multiple industries and growing exponentially in them. Energy and auto are the obvious ones, and we have a clear path to disruption in insurance, taxi, and commercial transportation. Even AI has legs within the Tesla's basket of tricks. In 1999, Amazon was still just a bookstore, with DVD and video expansions. Its true retail power only became apparent towards the end of 2000. But then delivery was still a huge issue outside of the US that needed resolution to enable Amazon to grow at scale. But current valuations are still based on belief in a different future. And just like in the dotcom era, when we were bombarded with hype and crazy stock listings, we now have a plethora of crypto assets making waves. And the whole SPAC phenomenon. I mean, just look at this idea. Investing in a shell corporation whose sole value proposition is that they will find you a deal and who are incentivized to close the deal, irrespective of the valuation. Or IPOs like Rivian, where a startup with no production capability is valued at $180 billion. Or high-flying tech stocks like Snowflake, Roblox, Palantir, and Upstart. This is the stuff that when it starts to unravel, will shake belief in valuations to the core. The dot-com era took 3 years to unravel before it recovered. With rising interest rates looming now, I believe that the current era of overhyped assets will do the same. It's inevitable. And it will pull the quality companies like Tesla down with it. And I can't wait for that to happen. Because if you're going to give me the opportunity to dollar cost average into Tesla for the next 10 years at Amazon valuation levels in 2001 to 2006, then I will take it. And I will retire extremely wealthy. The problem is that I really don't think the market is going to do that. I think the investment community has gotten a lot wiser in its understanding of disruption and how to value it. I think the EV revolution is disrupting too many industries. We might get lucky and get a 20% pullback. They'll be disappointing, but I'll take that too. If you like this video, please hit the like button and subscribe to my channel, and thank you for listening.